Hey everyone, welcome back to the show. Thanks for tuning in. My name is Mike. This is my whiteboard, and if you're brand new to the show, this is a show where we take concepts, we break them down, and we build them up visually for you. So today we're going to talk about holding an option through expiration. Last Friday was the standard monthly expiration for April, but what we're going to talk about today is going to apply to all the expirations at whether they expire on a Friday, which is normal equities, or maybe a different day if we're looking at something like SPX or the VIX. All these are going to apply, and we're going to talk about the difference between holding an option that's in the money through expiration and letting it expire to stock versus closing out that option and maybe buying stock or doing something to synthetically replicate what would happen if we just held it through expiration. We're going to talk about a few factors that differentiate the two. So let's talk about our first trade. We'll just create a hypothetical scenario where we're selling a put here, and we're just looking for our standard 45-day till expiration, selling an out-of-the-money put. So here we've got the stock price trading at 50, and we're looking to sell an out-of-the-money put at 45, and we're going to collect about $1 for it in this example. Now, as the trade goes on, let's say 45 days have gone by, the stock price swayed up and down a little bit, but it ended up going to 43 at expiration. We've got 0 days left. So let's say this is a regular equity trading vehicle. So we're looking at a Friday. So we're on Friday expiration. We've got just until the market close to trade this. And the stock price is at 43, and we've got our short put at 45. Well, the very first thing we need to do is calculate our P&L on this trade. Well, if I know that at expiration, this option is going to be trading for intrinsic value or very close to intrinsic value. In this example, we're going to assume that it's trading for purely intrinsic value. So I know that if I have a short put at 45, which gives me the right to become long shares at 45, and the stock price is at 43, this in the money put is going to have intrinsic value of $200. It's 2 points in the money. As you can see, the stock price is at 43 and our short put is at 45. So we're going to see a theoretical loss on this trade of $200. However, I did collect $100 or $1 at the beginning of this trade, which I can use to offset those losses. So even though I would have to purchase this put back for about $2 or $200 at expiration because there's no time value left in that option, there's no extrinsic value, I do know that I originally collected $1, so I can use that dollar to offset that payment that I'd have to purchase this put back for to give me a P&L of negative $100. So in any case, this would be a losing trade of $100. But there's a few things that I can do if I want to become long stock. So the very first thing I can do is hold this option through expiration. If we're dealing with TD Ameritrade, they'll automatically exercise the option and we'll become long stock at 45. So on the next slide, we're going to break down exactly what would happen if we were to do that. So if we let it expire and we hold it through expiration on Friday, on Monday we would come back to our portfolio and we would be long 100 shares. There's a few things to note about that though. So if we let it expire, we have the right to buy shares at 45. So what we're going to see is we're going to see our long shares at $4,500, or it's going to show us a cost of $4,500 to become long these shares because we're looking at that strike of 45. So we're going to see the long shares at 45, but we have to remember that our break even is at 44. All we have to do to calculate our break even is just look at the strike that we're dealing with. So in this case, the short 45 put option, and we subtract the credit we received from that strike to determine the break even. So since I collected $1, I would be looking to look at that 45 strike and then subtract $1 from that to determine my break even. Now, one thing that's really important to realize is that we're probably going to see a $200 loss on these shares. Because we're long shares at 45 now and the stock price is at 43, we will probably see a loss of $200 on the portfolio. But we have to remember that we did collect $1 at the beginning of the trade, so our real P&L is negative $100 even when the stock price is at 43, where we're $200 in the money. So we do need to realize our break-even's at 44, and in this situation, we're going to be long shares at 45, The stock price is going to be at 43, so we're probably going to see a $200 loss, but we know that if the stock price goes up to 44, where we see a $100 loss on this trade, or a gross loss of $100, we do know that that's where our break even is because of that original collection. So it's important to realize where our break even is while we're placing these trades, because the portfolio page on any platform, especially when we're long shares at 45 and the stock price is at 43, it's going to show us something different than what is reality. So if I know my break even's at 44, even if the stock price comes to 44, I'm probably still going to see a P&L loss of $100 on that trade, but I know that it's a break even because of that credit I collected originally. Now here's another important factor, and when we're talking with TD Ameritrade here, and if you have the dough rates with TD Ameritrade, there is an exercise fee per leg of $15. So if I were to let this option expire in the money, it's going to automatically exercise and turn into long 100 shares of stock, but there is a $15 fee to do so. So what is one thing we can do to potentially avoid that $15 per leg fee? And it's important to realize that it's per leg, not per contract. So I could have a 10 lot on this 45 strike, which just means I'm selling 10 puts instead of just selling one, and I would still just get charged that flat rate of $15. If this was a put spread, however, where maybe I had a long put at 44 and my short put at 45, I would have a $15 charge per leg. So I would have a $15 charge on that long leg at 44 and a $15 charge on the short leg at 45. Regardless of how many contracts I'm trading, it is a per leg basis, so that's important to realize. But again, what can we do to potentially offset that? Well, we're going to talk about that on the next slide here, where we're looking to close that position and just buy the shares outright. So if we were to close the put, which would just be buying it back, and then buy the shares at the market price, we can get that same result. So at the end of the day, we would still be long 100 shares and our put would be closed. So let's talk through what would happen there. Well, very first thing we need to do is buy back that put. So we would buy that put back for $200, since it's trading for $200 of intrinsic value right at expiration. And that's going to cost us $1.50 per option contract when we're looking at the dough rates with TD Ameritrade. So if I have to pay $1.50 per option contract to close my position, that's great. I'm fine with that. Now, what I'd have to do to replicate that same scenario is buy the shares. So instead of owning the shares at 45, now I would go out into the market and buy those shares at 43. And with that same commission structure, we're looking at a $7 flat rate for share purchases. So right away, we're looking at commissions of $8.50 rather than that exercise fee of $15. So maybe this option would be a little better. One thing that we need to realize, though, is that we do have the long shares at 43. So in this trade, we're going to see a P&L of 0 because really I'm closing out my long put, so that's going to be off my portfolio page, and I'm buying shares at the market price of 43. So it's not going to consider any of the previous actions that I took. It's just going to show me my new shares at 43, and that's something we need to remember. Because we're buying shares at 43, our break even is still going to be the same at 44, but if the shares come from 43 to 44, what we're going to see is a profit of $100. But we know that that's not really the case. Because of my previous position, where I had a P&L of negative $100, if I buy the shares at 43 and they come up to 44, my portfolio page is going to show me a P&L of positive $100. But if I'm looking at the Analyze page on the Dough platform, where I'm looking at the order chains, which keeps track of all the rolling and closing trades that I do, which is an awesome, awesome feature if you haven't checked it out yet, that's going to show me my break even, my real break even point, which is at 44. So these are a couple of ways to visualize and really see what's going on in the platform. The portfolio pages might show you one thing because it's only keeping track of the new trades and the current trades you have on, but it's important to realize that even when we're dealing with situations like this where I'm entering in this new trade where I'm buying shares at 43 and I have a negative $100 loss on the previous position, if the stock shares go up to 44, on the portfolio page, I'll show a profit of $100, but that's not really the case because I know my break even was at 44 in the previous example. So these are two different ways to potentially hold an option through expiration and either be assigned the shares by letting that leg exercise, or synthetically close that situation and become long the shares in another way. So this one, we looked at closing that long put and buying the shares, where in the previous example, we looked at just letting those shares exercise. And you can see that the two different scenarios do give you a few different results in terms of what you'll see next on the portfolio page. But let's wrap all this up with some takeaways for you. So the very first takeaway here is that the more extrinsic value there is in the option, the more inclined I will be to avoid exercising. So this is a hidden gem and a really good piece of information, and this is how I think of it when I look at exercise and assignment risk. So the more extrinsic value there is in an option, the more inclined I will be to avoid exercising. And that's especially true if I'm short an option. So if I'm short an option and there's a lot of extrinsic value in that option left, I don't feel any risk at all in terms of personal risk of being assigned. I know that the counterparty on the other side is long that option in some sort of way, and I assume that they're aware of that extrinsic value. If they exercise that option, they lose all of that extrinsic value. So let's say that same option that we talked about that was $2 in the money also had 50 cents of extrinsic value. So if my option was in the money, and let's say there was 10 days left to go, and my option was in the money, there's 50 cents left of extrinsic value, if I'm assigned on that put, that person actually just did me a favor, because if I was waiting for that extrinsic value to come out of that option before I close the position to further reduce my cost basis, if they assign that option early, they give up that extrinsic value, because shares are shares. There's no extrinsic value in shares. So if they were long that put in that example and they exercised their right to sell those shares to me, I would now be long those shares at the strike price, and the extrinsic value would have disappeared. So I would have been able to buy back those shares at the intrinsic value, and basically what they're doing is giving up that extrinsic value, and they're giving it to me in terms of cost basis reduction. So whenever I'm assigned early, very early on an option, I actually look at it as them doing me a favor, because they're giving up that extrinsic value, and I'm able to use that extrinsic value that I originally sold to use as cost basis reduction. So it's an interesting way to think about it, but that's how I think about it when I look at assignment risk. I look at where the extrinsic value is. If it's very low, then I might feel much more inclined to roll my position or close it because I would probably be assigned. But if there's a lot of extrinsic value there, I don't really feel at risk personally. Secondly, we do need to consider commissions and fees when we're looking at these scenarios. You saw that with the current structure with TD Ameritrade, the very first situation where we let it expire almost doubled the commission cost as if we were to just close that put and buy the shares. So depending on what brokerage you're using, it's really important to see what the fees would be and what would be best for you. And lastly, be cognizant of the break even going into the new trade. The portfolio in all of these trade platforms are only going to show you the newest strategy and the newest position you have on. So depending on how you got into that position, one might show you a loss of $200 like we saw here, and one might show you a P&L of 0. And even if we got up to our break even, that portfolio page would show you a profit where really we're just breaking even. So it's important to really understand your break even prices going into that new trade. So thanks so much for tuning in. Hopefully you enjoyed this segment. My name's Mike. If you've got any questions or feedback, shoot me an email at one of these here, or you could follow Mike on Twitter. Stay tuned though, we've got Jim Schultz coming up next with From Theory to Practice.